FirstHoldCo's financial year in 2025 numbers have become a test case for Nigeria's banking sector as lenders adjust to life after regulatory forbearance. A 93% collapse in full-year profits, driven by a record 748 billion naira impairment charge, heavily concentrated in the fourth quarter, has thrust asset quality, capital strength, and risk governance into sharp focus. While the scale of the provisioning has unsettled headline earnings, it also begs the question: is this a cosmetic cleanup or a genuine reset of Nigerian banking risk culture? Samuel Oyekanmi, Research and Insight Lead, Norrenberger Financial Group, joins me for more on this. Thank you so much for joining me today.
Thanks. Good morning for having me.
All right, now full-year profit collapsed 93% to 45 billion naira from 677 billion naira, and that was driven by a record 748.1 billion naira impairment charge, which is 75% higher than 2024. And of course, you and I know it was concentrated heavily in Q4 2025. What do you think about this?
Yeah, I think those are interesting numbers, right? For me, my reaction will be in two ways, right? The first one will be that, yes, having such huge decline in terms of profitability, 93%, is economically painful. But what it also means is that it means a better balance sheet, right? And from a financial point of view, from a banking point of view, it is always important when, despite the fact that we all want returns and increased profitability, to have very ideal and healthy balance sheet, right? And what it also signals for me is that before now, we've been having some significant under-provisioning, right? And this was pretty much driven by the CBN's initiative and reforms around last year to push a number of these banks to exceed that forbearance level that we had seen during the COVID period that was allowed for them, as well as the single obligor limit, right? But again, my first reaction would have been that, yes, a significant decline for a premier bank in the banking sector for Nigeria. It's of course has its own economic impact as well as a sway on investor. But I would look at it from a positive side that it's actually better for us to have a healthy balance sheet, right? Earnings quality would matter to me than having a top line that has a lot of reclassification embedded in there.
Well, that's quite interesting. But the next question for me would be, do you think this cleanup would have happened had the CBN not come up with this forbearance exit?
That's not likely. As you would know, most banks, right, they would rather prefer to reclassify and keep. Again, it's a game of emotions, right? Banks all know that one of the ways to sway investors is to keep turning out very good profitability, good bottom line, and those provisions, impairment provisions, will not allow them to be able to report healthy profits as they would want. So what you will find, if not for the fact that CBN has forced them into this, would be to, of course, reclassify. But it's also good that we find ourselves in this position where they are forced to do what is right for the books, clean up their books, and it's good because many of them have now exited the CBN forbearance. We're now seeing some form of exposures in terms of their reclassification. We've also seen increased provisioning, and what that also does again is that it tightens the credit standard, and again makes these banks more selective. It makes them more selective in terms of who they are loaning out, giving credit facilities to, and I think that's quite good for the banking industry as a whole.
Well, when you talk about that, another side of that coin is, looking at the bank's risk appetite. Is it going to dwindle?
Yes, would I say partially, right? For risk appetite, right? The fact that profitability has declined, what you find is that most investors might have some interim or temporary aversiveness towards banking. But I think in the long term, we're going to see that pretty much materialize for the banking sector. Well, for investors who look at it from a short-term point of view, maybe swayed, and we start seeing that, as you could see, at some point we saw some sell-offs even in FirstHoldCo's stocks and Nigerian stock market. But I think in the long term, it is good because what you will see going forward in 2026 is that they now have more healthy numbers, a cleaner balance sheet. You start seeing their loan portfolio looking more de-risked compared to when we used to have huge exposures to unstable economies and whatnot. And hopefully, if cost of credit begins to dwindle down at some point later this year, that could also have some positive impacts in terms of our non-performing loans ratio for the banks. As of Q2 2025, we already saw the number somewhere around 6%. That's like the highest we've seen since COVID-19 era, and that's not ideal from a prudential point of view. So of course, we hope that start getting better going into the long term.
Now, back to looking at what's happening now. What's been forborne, or let's say, some of these things, what does it tell us about how loan books are being managed or were managed before now? Because when you see some of these numbers, you're wondering, is there some form of relationship cordiality that goes into making these facilities available?
Yeah, I think it gives some signals, right? And of course, they are uncomfortable truths. But I also think that the system allowed it because coming from COVID era, we needed to inject more funds into the economy to drive economic growth. And as a result of that, the CBN allowed some forbearance and also some laxity around the single obligor limit. And right now, we saw a number of credit facility just being pushed out, even without the necessary due diligence that you might expect. And as a fallout of that, we're now seeing those have some impact. Like I also mentioned, things around our non-performing loans. And it's not like credit has even increased significantly, right? Because when you look loans to deposit ratio, as of September last year, somewhere around 51%. And that's pretty much in line with the CBN policy around the LDR, which is 50%, that was cut from 65% in 2024. But what it tells me, right, is that banks have relied a lot more on restructuring rather than resolving their credit area. So you think things around loan rollovers, tenor extensions, interest recapitalization, instead of recognizing them as actual non-performing loan. And then we also see that for some of these banks, you might see things around their weak early warning signs, like they're not able to detect some of these warning signs when they start reflecting up until when it gets to materialize. And I think that's not such a good sign. But hopefully going forward, as we see a number of the things that CBN has pretty much done to force many of these banks to act in accordance, hopefully that's also going to get better as we get into as we go into 2026 and in 2027. And of course, I mentioned things around interest rate. Of course, high cost of borrowing meant that a number of corporate and retail borrowers would have a strain in terms of paying back their loans, and that has also had some significant impact on the books of these banks. I think lastly, what I will mention again is things around sectoral vulnerability. I was looking at FirstHoldCo's portfolio in terms of their loan portfolio and see that almost 40% of their loan portfolio is tilted towards oil and gas. And you would find that a lot of those impairment provisions would come as a result of their exposure to that sector. So of course, there is a need to restructure the books. And I think again, I've been doing that quite well because in the last 1 to 2 years, a lot has really been done in terms of how their books now look compared to, say, about 4 or 5 years ago, of course, with the new management that they have on board. So I think that's quite positive going forward. All
right, I like that you've used FBN as an example, but I would like you to probably take an umbrella look of the sector and talk to us about how those banks are handling these issues. That's on the one hand. And I'd also like you to talk to us about how investors should sort of react to what's happening.
Yeah, so if you look at it from an umbrella view, right, looking at this sector, I think a lot has to have been done. Of course, we've seen quite a number of the financials, and we see quite a number of provisioning, things around signs that they are trying to de-risk away from those sectoral, those unstable sectors. And we hope that, of course, that materializes positively for them. So again, as an average person, for an investor, looking at the numbers as they come out, I wouldn't expect hyper profits like we saw in 2023, 2024, when a number of these banks had a massive gain from FX revaluation. We might not be expecting those sort of profits, at least for 2025. But what you'd expect is that the balance sheet side should look cleaner, better, And then away from that, with the whole recapitalization exercise, as this new fund coming to the business, it is best that it is coming into a business that has a very good book, right? Rather than those that are suffering from just inflated profitability that is not really reflective of where the actual business is, right? So I think investors should eye it from the angle that we don't expect so much profit going into as we expect their results to come out. But of course, what we need to start looking at is how their books are being how their books are in terms of their credit portfolio, their non-performing loans, capital adequacy ratios, things around that helps you to be able to give an indication. Again, when you look at those impairment charts, what stages of impairment are they? It also gives you an indication of how well these banks are in terms of recollection of their credit facility and whatnot.
Thank you so much, Samuel Oyekanmi, Research and Insight Lead, Norrenberger Financial Group. Thank you for coming on the show, for sharing your thoughts with us.
Thanks.